Good morning, ladies and gentlemen. This is Clueless 8, and this is the pre-market AM report for August 27th, 2015. Traders and investors around the world have witnessed history, and there are no words to describe the ferocity and the violence that's inflicted on the markets due to automated algo and high-frequency trading programs that react on a nanosecond basis to events that are happening thousands of miles away. The key is that every single move in the market, up and down, was forecasted to a large degree, not to the exact day, but to a very large degree, on my videocasts, on my Twitter chat, on my Twitter feed, my precision trade alerts, and market forecasts. Forecasting the market is a very tricky business, but technicals and the style and the methodology that I employ has been extremely accurate. I want to welcome the whole bunch of new members and free trial subscribers who are listening to this for the first time, that my service is very unorthodox, it's contrarian, and the mission statement of the Clueless 8 service is that we are an active trading community, both swing and day trading, long and short, with a very strong focus on financial education. Because if you don't know what's happening around you and what the big picture is, then you're going to have a very difficult time managing. The key word is managing your trades, not just entering a trade, but managing your trade in this uber volatile environment that we live in. Keep in mind that volatility is not going to subside. The advent of algorithmic high-frequency trading programs that dominate almost 90% or more of trading on a daily basis is going to cause havoc for traders and investors who are not clued in to what the real story is. My mission is to provide as much insight as possible within the realm of what I know and how I perceive things. And I believe that I have been, to a large degree, very, very accurate with my timely and actionable alerts. All right. Couple of quick behavioral game theory stuff here. What we're witnessing here is not something new. What is new is the speed and the violence of these corrections that take place. We lost, if I'm correct, almost 16% from 18,000. Here's the Dow Jones in the background, from 18,400, give or take, 18,000, 364 or 365, down to 15,370 points within a matter of 3 months. Within a matter of, keeping it more relevant, within a matter of a few days since last week, we lost close to 2,000 plus points. People who track my work, and every one of you should be reading every single post on the real-time Twitter feed, know very well the causes behind it. I don't want to get into it, in too much in detail. There are macro global economic causes like China, and then there is domestic situations with the pressure on high yield bond spreads that basically exploded higher, the default risk. You had panic situations, triggers, going off, and a good number of hedge funds which dabble with high leverage or with extreme leverage in the commodity market basically blew up. Now, that's not something you're going to hear from the CNBC and Bloomberg and such. Time to time, you're going to hear some guys talk about it. But the institutional forced margin sellouts, keyword, institutional forced margin sellouts that are taking place due to the large number of massive multi-million dollar, hundreds of million dollar margin calls have to be satisfied before the selling pressure subsides. That is exactly what happened yesterday. Now, I try to take advantage of all these things on a very timely basis, and the reality is that right now we're just getting just a quick interruption. We're getting the second quarter GDP estimate. This is the second estimate for Q2, and that's coming in at 3.7% versus 3.1%. And the preliminary one that was this is the second estimate. The first estimate was 2.3%. The GDP deflator, which is a measure of inflation, is up 2.1%, despite the fact that we have had a crash in commodities. So this is very interesting stuff here going on. All right. So I repeat again, the second quarter GDP estimate just came out. We're going to see, I'm going to switch to the future screen in a quick second. Maybe I'll just show that to you right now. Futures obviously are liking this. Let me get it closer. There you go. I'm going to cover this chart in a quick second. And the futures are up right now, 19.5, 20 points. So what it clearly shows in simple English is that the U.S. economy is healthy, and we are not seeing any major deterioration, despite the fact that we had a crash on the commodity side. So in other words, let me switch back to the Dow chart. In other words, we are not going into a U.S. global recession. That obviously helps bolster the case that we're not at this point going into a large scale global recession, which means that we're probably not going to be, that's market positive. Just keep it simple as that. So from a behavioral game theory standpoint, what we witnessed, like I was saying, is not something new, but the reaction is always the same. The speed and the ferocity is new because there were a larger number of players who got really hurt in the commodity complex, and that had a ripple effect across the board in the high yield bond market. And this is just the way it happens. And the speed of the algo HFT programs, just did the job. So at this point, let's look at things simply, because I want to cover as much as possible within this 15-minute video cast. The best way to measure it is to do a Fibonacci retracement. If you do this from the top of the Dow, 18,352 or so, then a 50% retracement brings us up towards 18,872. So that looks like where the Dow wants to go. Now, 18,000, now this is on a swing basis. This is not happening in one day. So give it a couple of weeks. So 16,871 is roughly about 600 points from here. And a 50% retracement is generally standard within the context of a large-scale drop. We can also go ahead and move the Fibonacci. One second. Here, the reason being that the crash really started right at these levels, right, on last week. So if we zoom in and try to figure out from a forecasting standpoint where we can have an immediate bounce, we basically have another 250 points, which is a 50% level at 16,473. So in a way, it's really as simple as that. Now, is it possible? Is it possible that we retrace this in a V-shaped bounce? We did that last October. I'll show that to you and we actually overshot. That was last October, middle of October, when we had the previous crash. And that was also because of high yield concerns, Ebola, and a slew of other things. So yes, it is. So that would basically bring us on a daily chart. This is a daily chart to retest the 50 and the 34-day moving averages. People who follow my work have realized how accurate these parameters are, and that the 50 and the 34 retest acts as a magnet. Now, what happens after that remains to be seen. But if the bullish case would be that we jump from here, where we are right now, up 1,000 points, up to 17,345, 17,486, and then look to see whether or not this bull market is intact, whether we're going to make higher highs, or whether or not we're going to fail here, do another 50% retracement, and all that good stuff. All right, it's really as simple as that. Now, let me take a look at let me exit this. Let's take a look at the E-minis, which is and look at a shorter term picture. Let me get all these lines out of here. Now, this is a representation of the futures market on the S&P 500, and we can do the same thing. And I've shown a series of charts with these Fibonacci retracement and what's going on. Now, looking at the daily chart here and looking at the internals, let me start off from the bottom. It clearly shows that we're in an uptrend at this point. And unless we get fully overbought up in the 90 to 100 level, we are going to continue with this uptrend. In between intraday pullbacks and all kinds of good stuff. This is on a daily basis. Now, my other charts, which is the Swing 533, which I'll cover tonight, now I'll actually put them up, are also showing that we are on a powerful swing move up that wants to claim that won't stop till we get overbought again. Okay, so this was last October. Let me go back to this. And this is a very simple way of looking at it. The other way that I teach in my advanced coaching sessions, and I've talked about it extensively, I highly recommend everyone join the group sessions, sign up for the group sessions, is when you get the McClellan oscillator down to these horrific levels of minus 350, minus 345, or even down here to minus 151, and that's where we are right now, and down to, let's say, 250, you literally buy, and if you're really, traders are not technical robots, right? They're human. So you have to go in there and you have to basically buy the market. And that's from a technical perspective. You keep all your emotions aside. That's pretty much what we did. That's pretty much what we did. It doesn't mean you have to go in there and shove in all your trading capital in one go, but the fact is that these internals, these simple internals clearly show you where the market's heading. Now, what happened last October was a monumental generational buying opportunity. I've talked about it extensively, where you drop down to these levels. I know we didn't touch October's levels exactly, but neither did we drop from as high as that. We dropped from here on the S&P from about 2,000, and we went to 1,800. We had a move like this. Now, keep in mind, I like to remind everyone, very simple terms. This didn't happen in a straight line. This happened in between zigzags along the way. To stay and manage in the trade is exactly the reason why you need to stick to what the Clueless 8 service, the charts, the trade alerts, the commentary is providing on almost on an hour-to-hour basis. Because nobody bought at the lows. We bought the lows, but it's not like we held everything all the way up there because no one knew the markets were going to move like that. So at this point, are we going to have a pattern symmetry that brings us all the way up there? It is possible, as I said before, on the Dow Jones and now on the S&P here, is that we go ahead and test this downward sloping 34 and the 50-day moving average. So that would bring us up to the 2074 level. Now, these are big pictures, and I'm not going there that it's going to happen right away. But there is a possibility that we get a monster move as China picks up and things heat up around here. GDP numbers coming out real strong. The Fed goes ahead and raises rates slightly, a quarter of a percentage point in September, which would be extremely positive for the markets. And so get ready for it. Get ready for a real macro move. But in between, you have to manage your trades, and you'll have to follow what I'm saying, or at least, my goal is not to make you money. My goal is to provide you with the tools, precision tools for you to do your best to make money for yourself. And I want to be very clear about that. All right? next video.